Some of the memory makers have reported earnings like Seagate. And we talked about Seagate with our semiconductor insiders last week on one of our live events, our Q&A sessions that we hold weekly. What follows is an excerpt from that.
And as you watch that, you will see some visuals from our friends over at Fiscal.ai. Starting this Thursday, May 7th, Fiscal.ai is having one of its biannual sales, 25% off. If you're looking for a complete platform to do deep dives into the companies you invest in and figure out which new companies you want to invest in, make sure you check out Fiscal.ai/CSI. It gets you 25% off. Starting this Thursday, May 7th.
The discount is only good for 1 week, so make sure you check it out in the description below.
Let's talk about Seagate.
Yeah, let's talk about this quote-unquote structural change, the term that they're using right now. We talked about Seagate a number of times now. It's an HDD business, hard disk drive business. We won't go into the nitty-gritty of what they do, but taking a look at their total revenues and the total HDD exabytes shipped. That's the metric that they report most directly now, exabyte.
And this is a super interesting chart because, as we all know, computing and data is very much a secular growth trend. The amount of compute and the amount of data computed will continue to increase for a long time. But the beauty of the semiconductor industry and the curse of investors in the semiconductor industry is customers demand that you basically continue doing more compute of data for them at lower cost. And within this secular growth trend, we had called out HDDs as historically something that for a while now has been in secular decline, while other types of memory semiconductors, especially NAND flash, SSDs, solid state drives, slowly increased in market share. But what has structurally changed? Because now, yes, the exabytes shipped are still going up, but suddenly we have this flip from, well, it looks like secular declining business to, hey, it looks like we're headed back to not just multi-year high points for revenue, but maybe all the way back to the highest revenue in over a decade for Seagate. This is where the commentary is coming from on what has structurally changed. So let's dig into this a bit more.
Yeah, this is Q3 fiscal year 2026, so only one more quarter left in Seagate's fiscal year. Revenue came in at $3.1 billion for the quarter, which is up 44% year over year. They expanded their gross margin to 47%, which is fantastic. I think they were at 41-ish, 42 last quarter.
That's a very high gross margin for hard disk drives.
Earnings per share, $4.10, is up 115% year over year. We're going to talk about that a little bit further. So all across the board, Seagate is expanding the numbers. Here's another look at the revenue cycles. This is on a quarterly basis, January 2018. So very clearly, based on just the revenue numbers alone, historically, a cyclical business and a significantly declining one up until recently. The hard disk drives are coming back in vogue because there is so much storage needs for AI-generated content, inference, you name it, and there's just not enough memory on the market. So let's take a look now at their exabytes shipped,
which is one of the inputs you need to calculate revenue. Kind of secretly behind the scenes, when semiconductor companies price their product for the extra performance you're giving the customer, that allows you to dictate the average selling price, the ASP, which is how you calculate your revenue. But specifically for memory companies and Seagate in particular, the number of exabytes you can cram into a device and sell to the customer will dictate how much you can charge per device. So the exabytes shipped is not the problem. That's not what is in secular decline here, especially nearline HDDs. So if we go back and think about the memory architecture, what is a nearline hard disk drive? Nearline data is reference to data that goes into long-term storage, usually some sort of non-volatile storage. This is data that only needs to be called up very infrequently, let's say once every few weeks, or maybe even longer. But the demand, as Casey just mentioned, with the advent of AI, is now when that data is recalled, it's not someone calling up some obscure piece of data or a website on the internet when doing a Google search, and you can wait 5 seconds for the page to load or whatever. If it's an enterprise use case, you can sit there and wait for a while for the request to be delivered to you. Now we need it fast because the AI needs it for training or for inference. So you better get it almost instantaneously. So this is why those nearline exabytes shipped continue to go up now, specifically in this AI era, and why the company is talking about things like a structural shift, because they have dramatically increased the performance of HDDs in recent years and the capacity. And so they think, while these hyperscalers, because of their AI needs currently, we think we're going to be shipping a lot of nearline exabyte devices for a multi-year period. They just need so much of it.
Just as a side note, they're on Mozaic 4 systems, which I think have 40 or 42 terabytes.
It's a lot.
It's a lot. They've started shipping that in late March, and then they'll start working on Mozaic 5, which is over 50 terabyte capacity, and they plan that to be able to be shipped in late 2027.
And it's super fast, thanks to the hammer technology, hammer time. The silliest cliche.
It's good. It's good. And also in the earnings call, they mentioned that hyperscalers have got plenty of RPO dollars at work coming for Seagate. We broke down their two revenue segments. One in green is data center revenue, and then edge IoT revenue is in blue. And obviously, data center revenue is where it's at right now. 2.5 billion of the revenue in this quarter was from that. And then free cash flow is in orange. They had the best free cash flow they've had in a decade, 953 million. And this kind of goes back to that leverage discussion that we had a number of months ago. When there's fixed costs for some of these companies, they have this extra cash flow, this extra revenue, they sell more product. It goes directly to free cash flow through the balance sheet. And then you can see their margin expansions. That's the purple line there. They've continued to make good on this, expanding their margins.
This actually is a good opportunity to talk about the strategy, some of the questions that were submitted this week on strategy with dealing with some of these companies. If you think, okay, maybe it lasts a year, maybe it lasts 2-3 years, maybe longer, who knows, of this period of a company like Seagate over-earning, how do you handle that as an investor? And also, what's the best outcome for the company and for its shareholders after this period of really incredible growth maybe slows down or has a down cycle? What does the company do with all that cash during this period of over-earning?
And now let's take a quick look at the Q4 guidance. This will wrap up their fiscal year. Revenue implied 41% year-over-year revenue increase, 3.45 billion. So year-over-year, they expect a 41% increase. And then that earnings per share is going to continue to go up, $5 for this next quarter, which would be 123% increase year over year. Pretty incredible.
So at least through the first half of fiscal year 2027, there's a pretty decent chance that this close to triple-digit earnings growth rate continues. Pretty fantastic. Operating leverage, again, like you just mentioned, definitely at work.
This is from the CEO. He's talking about the cloud service providers. The three bigs, $1.1 trillion in RPO. That is their remaining performance obligations for their CapEx expenditures for accelerated compute infrastructure build out. So a lot of money, but Seagate is taking a decent size of the pie, not trillions.
Yeah, this is where some of the estimates come in that perhaps the CapEx number even goes to above $1 trillion next year in calendar year 2027. Pretty epic infrastructure build out. Let's finish off Seagate here and then go back to the questions about how do you handle this? If you own Seagate like we do, how do you handle it?
When I was preparing this presentation, stock price was around $687. We used a 100% earnings per share on this reverse DCF, which is $10.54. Seagate's a nice, well-established business. We put this out for 3 years. That's our estimation, at least at this point. Gets us to a growth rate of 56% over the next 3 years. Terminal rate of 5%, discount rate left at 10%.
56 each year?
Each year, which seems impressive. It seems difficult to do. But as you just mentioned, Nick, earnings per share are growing triple digits.
At least some of that growth rate for the next 3 years is going to be pulled forward into this year, basically. It's an insane number. I assume you took it out to 3 years on this particular scenario because we're going to keep calling out the perhaps critical year, 2028, as a possible slowdown at the very least in this whole data center build out thing. happy to own it. And we're just going to take it one quarter at a time with these memory companies, Seagate included. This kind of goes back into some of the conversations, especially the one a couple of weeks ago about a company that's a price taker versus a price maker. You recorded a brief little short about that one. This also even more fundamentally goes back to the discussions on what is a commodity versus a finished product. And a lot of these companies are in a period of over-earning. They're a price taker. While the money is being spent, while the growth CapEx is being spent by the hyperscalers, they are in a period, we don't know how long it will be, where they are earning more than they will on average over the long term. So best case scenario here is there's a number of different ways you can handle this. You can handle it via a portfolio allocation decision. If these memory stocks continue to just skyrocket far above what the market average is giving you, and suddenly you find yourself in a situation where you have way too much of your portfolio allocated to memory or some other commodity component that is part of a larger computing system, you may choose to sell or at least trim and rebalance or something like that. Option one, let's say. Option two, we start to see a slowdown in the growth trajectory. It's going to come. This CapEx cannot just continue growing for forever. So maybe you give it another 6 months to a year and you decide, okay, I'm going to trim a little bit. And then in another 6 months, I'm going to trim a little bit. And you do the method that we talked about just earlier, where over time you gradually just trim, take profit, and move it to the sideline in anticipation of those growth rates slowing down or even reversing course like a normal cycle would work. Who knows how long it'll take? Option three, I don't know, depending on your trading strategy, maybe you just continue to hold and let the momentum run all the way up until the point where you definitely can see the party coming to an end, and then you move on to the next thing or hold the cash and wait for the next thing. It's going to depend on your style and how you invest, but there's a few ideas on how you might handle this. When there is eventually a washout for the companies that are participating in this, especially Seagate, we noticed one of the things they did with their excess cash this quarter was pay off some debt. Ideally, you would like to see them, the longer this bull market continues, pay off a lot of debt or maybe all of their debt and get back to a position where they have net cash on balance. Because the fact of the matter is HDD technology is quite aged at this point. There's no indication that hard disk drive technology is going to have this resurgence and it's going to just not be in secular decline ever again. Chip technology, semiconductor technology like NAND flash will probably steadily increase market share over time, gradually over the course of many years. So the ideal outcome after there's a washout for a company like this, maybe there's a crash in the stock price, the stock looks really cheap again, and you would want management to then go back to prioritizing shareholder return via dividends, maybe even a special dividend, share buybacks, that sort of thing. But after the washout in the stock price, ideally, because this is most certainly still going to eventually be a cyclical business again. Everybody will come to their senses and we'll all 5 years, 10 years from now, look back on this period and say, what were we thinking? Collectively, what were we thinking?
Structural change. Good explanation.